Imagine prices climbing, jobs disappearing, and growth grinding to a halt all at once. That's stagflation. Today, we're diving into how it happens, why it's so tricky to beat, and what it means for the US economy right now. Stagflation is the rare and dreaded combo of stagnant economic growth, rising unemployment, and accelerating inflation. Unlike a typical recession, where prices often fall, stagflation brings higher costs on top of job losses and flat output. Here's the catch. To fight inflation, central banks raise interest rates, slowing borrowing and spending. But that can worsen unemployment. To boost growth, they cut rates, but cutting fuels inflation further. It's a no-win dilemma. Stagflation first made headlines in the 1970s. Oil exporters slashed crude supply, sending energy costs through the roof. Between 1973 and 1974, oil prices jumped over 300%, pushing inflation to double digits while growth slowed and unemployment rose past 9%. Fed Chair Arthur Burns hesitated on rate hikes, fearing a deeper slump. Inflation expectations got stuck. It wasn't until Paul Volcker's aggressive hikes in 1979-81 that the U.S. endured a painful but successful comeback, proving that hard choices sometimes pay off. Fast forward to early 2025. U.S. inflation has cooled from pandemic peaks, but still hovers above the Fed's 2% goal. Food and housing costs keep households on edge, even as energy prices ebb and flow. Meanwhile, GDP contracted slightly in the first quarter, marking the first drop since 2023. Unemployment remains low by historical standards but is inching above what the Fed considers full employment. It's a subtle warning sign. Supply shocks are back. New tariffs on key imports have added a hidden tariff tax to goods costs. Manufacturers pay more for parts, and consumers face higher prices, squeezing both production and wallets. Labor markets are tight, and average wages are rising faster than worker productivity. That gap pressures firms to increase prices further, risking a wage price spiral that keeps inflation stubborn. Energy markets remain unpredictable. Geopolitical tensions and production cuts could trigger another run-up in oil prices, fueling headline inflation and testing already stretched household budgets. For families, it means shrinking paychecks. When prices climb faster than wages, essential spending on groceries, rent, and utilities crowds out other needs, forcing many to cut back or take on debt. Businesses hit pause on expansion. High borrowing costs deter new projects, while unpredictable costs make long-term planning a gamble. Small firms with tighter margins face the brunt of the pain. The Fed stands at a crossroads. Hike rates to stamp out inflation, risking deeper slowdown. Hold steady to support growth, risking entrenched inflation. Their May 2025 decision: rates paused at 4.5%, buying time to gauge the next move. On Capitol Hill, targeted relief can help, meaning direct support for low-income households or critical industries. Unlike broad stimulus, targeted measures ease hardship without supercharging overall demand. Longer term, boosting productivity is key. Modernize infrastructure, unclog supply chains, and foster competition. These fixes take time but lay the groundwork for sustainable, low-inflation growth. Optimists point to a soft landing, a mild slowdown that brings inflation back to 2% over the next year without tipping into recession. Key indicators: steadier job gains, cooling core prices, and renewed business investment. But if supply shocks persist and wages chase prices higher, the U.S. could slip into true stagflation, a prolonged era of low growth and high prices. History shows it takes tough medicine and time to break that cycle. Stagflation may seem like economic jargon, but its impact hits every American's wallet. By understanding the forces at play, supply shocks, wage dynamics, policy trade-offs, you'll be better equipped to navigate uncertain times.